Welcome back to my channel, investors. In this video, I'm going to be covering Whirlpool. This is the big appliance company that's headquartered here in the United States and has a long list of brands that Americans have been using for decades. It is a company that did really well during the COVID years. More recently, the stock price has really been falling, which is interesting. This is a high dividend paying stock, and I believe this is a good company. They have a history of paying very good dividends. They have very well known brands. They have a great parts business for all their installed appliances. There's just a lot of value that I see in Whirlpool. And the stock price falling shows to me that there may be value in this stock. I'd like to value the company based on free cash flows and their earnings per share and compare that to their current stock price. I'll make a decision whether I should buy shares of Whirlpool or stay away from this stock. Let me show you more on Whirlpool. Let me take a look at the fundamentals behind Whirlpool. First, they're a $6 billion market cap company, so they're a small cap company. Even though their brand is really well recognized and they have really valuable brands, their market cap is really small. Their revenue is close to 20 billion, so you are getting a very large revenue company for a very small market cap. The forward PE is under 8, which is interesting. That's really good for a company. And their dividend is 6.5%. This company has raised their dividend over time. And it's really good to see that if I own this stock, it'll yield 6.5% dividend. The reason for it, over the last couple of years, stock price is down 57%. And as the stock price goes down, that dividend yield goes up. So if this company is going to right the ship and really get their business right, this could be a nice opportunity. I'm going to value Whirlpool based on the free cash flows I expect the company is going to produce in the future, and then getting a net present value of those cash flows. I'm also going to value the company looking at their earnings per share and valuing the company based on earnings per share. Then I'm going to blend those two valuations to arrive at my value of the company to see if it's a good price for the stock, if it's being sold at a discount, at a fair price, at a premium. Let's start with free cash flows. So Whirlpool's seen their business really go up and down during COVID. The initial COVID year really made their business go away. They had a loss in revenue, but then it was followed by 2021 being just a huge year. 2022 followed. A lot of people wanted to get new appliances in their homes. People were stuck at home and they were buying appliances, and they were able to really record record revenues, record cash flows. That said, with all that type of volatility, the cleanest number that I could find is 2019. This is pre-COVID. This is just the way Whirlpool historically is run. So I took that number and made that my starting point for free cash flows and added the growth that I expect in the company. The growth that I expect in the company for free cash flows is going to be 4% a year, nice and conservative, starting with 726 million in year 1 and leading up to 817 million in year 4. All cash flows beyond year 4 in terminal value will grow at 3%. I'm going to take a net present value of all those cash flows based on a 9% discount rate. I'm going to get to $11.6 billion is the value of all those cash flows if you look at the net present value of them. They have $1.5 billion of cash. I'm going to add that, but I'm going to take away debt, which is 7.2, to get to an equity value of the business, 5.9 billion. The market cap is pretty much there, 5.9 billion. So based on free cash flows, the company is fairly priced. Earnings per share look really good, and they're supposed to grow. 2024 is going to be good at $13.68. Next year is supposed to be even better. And I'm going to put a 12 PE on that earnings per share, and I'm going to grow those earnings by 3%. When I use those metrics, I get to a value based on earnings per share of $140 per share, but their current stock price is 107. So it provides a discount of 30% available if you look at earnings per share of Whirlpool. If I blend the two, I get an 11% discount on Whirlpool. Now, I have high regard for Whirlpool. I think it's one of the good companies in the United States. Again, they have very good brands. I think their business is going to bounce back. An 11% discount really makes sense to me. I don't know if the stock price is going to fall any further, and they are paying a nice dividend of 6.5%. So I like the discount of 11% on Whirlpool. My summary of Whirlpool, I look at a company from 3 different places. First, do I want to be a part owner in the business? And the answer is yes. Do I think the industry is good? I do like the industry. I think it's a very steady consumer discretionary / industrial industry. And the company has a very good management team. Next, I look at the balance sheet. And in the case of Whirlpool, their debt is less than 3 times EBITDA, which is good. It's a qualifier to invest in a company because their balance sheet's in good shape. And they do offer a good discount, 11% on a very well-known company, a steady company that pays a nice dividend. So I'm going to be buying shares of Whirlpool in my income portfolio. This would be a nice addition to my income portfolio that I want to generate income for me. Whirlpool has seen its stock price really go down, and I've bought companies that were in similar situations in the past, and it's really worked out nicely. I saw the stock price go up, and meanwhile, I was paid a nice dividend. I'm hoping that Whirlpool takes the same path going forward. I hope you found the video interesting, and I appreciate you watching.